And the bond market is starting to sniff this out. The yield on a 30-year US Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. By the way, oil prices are now above $74 a barrel. They've been consistently rising over the past several weeks, as are a lot of other commodity prices. This is an amazing thing, and I posted this chart on X. But if you look at the CRB index, commodity prices, today it's at a 14-year high. 14 years. And in the last 7 months, we're up over 28% in commodity prices. And that's in dollars. They're up more in euros. They're up more in Canadian dollar.
Welcome to the Economy Express channel, your trusted source for financial insight and market updates. Tonight, we're tackling the urgent warning from renowned economist and financial analyst Peter Schiff about the brewing storm in the global economy. Rising bond yields.
Dollar's been strong. So commodity prices are surging all over the world, right? In Europe, they're up over 30%. Christine Lagarde had a Twitter or an X post. She had a little video of herself. She's head of the ECB, and she greeted everybody by saying 2025 is going to be a great year. This is the year inflation is coming back down to 2%. I mean, what is she smoking? It's first of all, it's about 3% now, but it's headed in the other direction. Prices are surging all around the world. Yes, we had a pullback in commodity prices as the Fed was initially tightening, but that's reversed. And again, we've had strong commodity prices, even with a strong dollar. So imagine how much stronger they're going to be when the dollar weakens, which eventually it is going to turn down. And, this is despite oil. We're at a 14-year high. So oil has been a lot higher than $74 a barrel in the last 14 years. It's been well above 100. So oil is one of the bright spots in this dark cloud here of prices. Other commodity prices. Look at coffee prices, right? Look at sugar. Look at cocoa, right? And other grains are starting to move. Look at soybeans. Look at corn. All these food items. Everything is surging in price. At the same time, the Fed and the ECB, they're all saying, hey, we've won the inflation battle. We just want to make extra sure that we're down to 2%. They're not even close. And the bond market is starting to sniff this out. The yield on a 30-year US Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. In fact, you have to go back even further than that. But again, this does not surprise me. This is exactly what I was saying was going to happen even before the Fed started cutting. But I said that when the Fed did cut, but we are moving substantially higher. Mortgage rates now are back above 7% and rising. They're going to be above 8% pretty soon for a 30-year fixed rate mortgage. But they're back above 7. Credit card rates are 25%. They're going to keep going up. Now, we got more bad news. I mean, forget about the fact that the mainstream media is ignoring this boom in commodity prices. I mean, which is completely inconsistent with the story the Fed is trying to sell. How can they be telling us that inflation is going to come down when prices are soaring? And these commodities, these are input costs. So they're going to bleed in to producer prices and consumer prices, right? They're going to move first. And then you're going to see it going, up the chain. So these are leading indicators. So how could you ignore? The last time we started to see commodity prices surging like this, it was before inflation really ran away. And then in the face of it, the Fed was still claiming that inflation was transitory, even though commodity prices were showing that that wasn't the case. Well, that's happening again. Now they're saying that, inflation's gone and commodities are surging. They are the result of the inflation that is already there. The Fed never put out.
Skyrocketing commodity prices and persistent inflation are setting the stage for what Schiff describes as economic chaos. Let's dive into the details and explore what this means for investors like you. First, let's talk about the bond market, arguably the canary in the coal mine for economic troubles.
The entire time. And now you're seeing it in these commodity prices. You're going to see it more in oil. Again, one of the reasons that we didn't have a bigger move up in oil when Biden was president, he's still president for a few more weeks, was his politically motivated decision to raid the Strategic Petroleum Reserve. Imagine where oil prices would have gone or might be now had we never, let loose all that oil. I mean, we didn't have to drill, baby drill. We just tapped. We just sold the oil that we already had. But that card has been played. Trump is not going to do that, and so we're not going to get artificially low oil prices. Now, some people think, well, we're going to drill more oil, maybe, but not until the prices are a lot higher, because American oil companies are not going to invest in development and more capex for more drilling at $74 oil. They're just not going to do it. It's not high enough, But yes, if oil is back above 100 and it looks like it's going higher, and yeah, we'll probably get some more drilling. But that's not the environment that people expect. Everybody is talking about $40 oil. Well, at $40, no one's drilling oil, despite the fact that they're ignoring commodity prices. And I don't see anybody talking about it. They couldn't ignore the economic data that came out today. There was a big jump in prices paid in the PMI. It was the ISM Services Index, which was higher than expected. It was one of the only economic data points that was above expectations, although we did get jolts today that was above. But it was at 54.1. But the prices paid spiked up, highest level in 2 years. Obviously, there's a lot of inflationary pressures that have been building, and that spooked the bond market, together with the JOLTS numbers that showed a spike above 8 million in the job openings. And I think part of that has to do with optimism. There is a lot of misplaced optimism among businesses that things are going to get better because we have Trump. Now, that's going to fade relatively quickly once Trump becomes president and things don't get better. In fact, at his press conference again today, Donald Trump again reiterated how things are going to immediately get better. He said it's going to be right away. We're going to have this instant boom, right? Everything's going to magically get better when he's president. That's not going to happen. And when it doesn't happen, then a lot of these job openings may disappear because the businesses are going to lose more workers. So are going to be very disappointed as the data, especially when it comes to inflation and the Fed rate cuts. Now, the probability of rate cuts declined today after the release of this hotter than expected inflation number. And as soon as it came out, gold, which was up about $25, sold off. It still ended up, positive about 13, 14 bucks on the day. The dollar, which was down this morning, and actually had a big pop yesterday, the dollar rallied. I'll get into that after the break on why the dollar rallied. But the dollar sold off as soon as this hotter than expected inflation numbers came out. But it's not just the inflation numbers themselves that caused the dollar to rally, but it was the reaction in the bond market where the bonds were hitting new lows for the year on this news, and that increase in bond yields is propping up the dollar. But that's not good for the dollar. The currency traders still don't get what's happening. They're still of the opinion that hotter than expected inflation just means the Fed has to fight hard, bullish for the dollar. Well, that's not what it indicates. I've been saying this all along. It doesn't indicate that the Fed has to fight harder to win. It indicates that the Fed has already lost. Inflation won the war. And this is not bullish for the dollar. Inflation is going to keep getting worse. Yes, it may slow down the rate cuts, but the Fed is not going to hike. Even though it never should have cut rates, all 100 basis points were a mistake. They're not going to be able to correct the mistake, because to do that, they're going to look so foolish if they have to do that. But not only do they have to take away all 100 basis points, they need to have rates significantly higher than where they were when they started cutting. There's no way the Fed is going to do that. The only thing they're going to do is slow down the cuts. I can't see Powell hiking rates at all, even though he should. But he may not cut. But that's not
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
The yield on the 30-year US Treasury has surged past 4.9%, with the 10-year yield hitting 4.69%. These are the highest levels we've seen in years. To put this into perspective, this spike in bond yields directly translates to higher borrowing costs across the board. Mortgage rates are already above 7% and climbing. Schiff predicts they could soon exceed 8%, adding strain to home buyers and putting further pressure on the housing market. Credit card rates, already a staggering 25%, are expected to rise even higher. What's driving these shifts? Inflation is not only alive and well, but it's accelerating, and it's being fueled by a dramatic surge in global commodity prices. The CRB Commodity Index, which tracks a basket of key goods, has climbed over 28% in just 7 months. This puts the index at a 14-year high, and the momentum shows no signs of slowing. Oil, for example, is trading above $74 per barrel and looks poised to head higher. But it's not just oil. Agricultural commodities are also on the rise. Coffee, sugar, corn, soybeans, these essential goods are all seeing significant price increases, pushing up costs for businesses and consumers alike. Now, consider this. These price surges are happening despite the dollar's relative strength on the global stage. In fact, if the dollar weakens, a scenario Schiff believes is inevitable, commodity prices could rise even further. Schiff points out that in regions where currencies are weaker, such as Europe, commodity prices have already increased by over 30%. So why are central banks claiming that inflation is under control? Both the Federal Reserve and the European Central Bank have been touting progress toward a 2% inflation target. Christine Lagarde, head of the ECB, even went so far as to predict a bright 2025 with inflation comfortably down to 2%. Schiff dismisses these claims as overly optimistic and disconnected from reality. He argues that central bankers are ignoring the very real and very visible warning signs, like rising commodity prices, that inflation is far from defeated. The bond market is already reacting to this disconnect. Higher yields signal that investors are losing confidence in the Fed's ability to manage inflation. The latest data doesn't help either. The ISM Services Index, a key measure of economic activity, showed a sharp rise in prices paid, reaching its highest level in 2 years. Meanwhile, job openings unexpectedly jumped above 8 million, reflecting misplaced optimism that economic conditions are about to improve. And then there's gold, a critical safe haven during times of economic uncertainty. Schiff sees gold as one of the best investments in the current environment. As inflation erodes real interest rates, gold is poised to shine. Central banks around the world are reducing their reliance on the US dollar and increasing their gold reserves. Schiff believes this trend will continue and advises investors to do the same. He predicts an explosive rally in gold and silver prices in the coming months, driven by growing concerns over inflation and currency instability. Schiff also highlighted the broader economic adjustments needed to address these challenges. For the U.S. to achieve lower inflation and rebuild its manufacturing base, Americans need to save more and spend less. However, this would require a painful economic transition, including a likely recession. Schiff argues that the US economy is overly reliant on consumption-driven GDP, which isn't sustainable in the long term. In closing, Schiff warns that the Federal Reserve has already lost the battle against inflation. While they may slow down rate cuts, they are unlikely to reverse course and hike rates significantly. This failure to act decisively will lead to further erosion of the dollar's purchasing power and a growing appeal for alternative assets like gold. So, what does this mean for you as an investor? The key takeaway is to prepare. Consider hedging against inflation by investing in gold and silver, exploring undervalued gold mining stocks, and looking toward emerging markets for opportunities. The global economy is at a crossroads, and staying informed is your greatest tool for navigating these uncertain times. That's all for tonight on the Economy Express channel. Stay tuned as we continue to bring you the insights you need to stay ahead in today's rapidly changing financial landscape. Thank you for joining us, and until next time, keep watching the markets and your investments closely.